Brad Williams, Frugal Finance, Eurodollar futures. Secured overnight financing rate, SOFR, as its preferred alternative rate for USD SOFR. SOFR is a measure of the cost of borrowing cash overnight collateralized by U.S. Treasury securities and is based on directly observable U.S. Treasury-backed repurchase transactions. SOFR took over LIBOR effective 2023. If you want to read up on LIBOR and why it was removed, because it was a scandalous currency. The most popular interest rate futures contract in the U.S. is the 3-month Eurodollar futures contract traded on the Chicago Mercantile Exchange. The Eurodollar refers to a U.S. dollar that has been deposited in a bank located outside the United States. The Eurodollar interest rate is the rate of interest earned on Eurodollars deposited by one bank with another bank. It is essentially the same as the SOFR rate. So any place you see LIBOR, it's because I didn't change it. It just kind of gives you an idea of how dated some of this information is. The 3-month Eurodollar futures contracts are future contracts on the 3-month, 90-day Eurodollar interest rate. They allow an investor to lock in an interest rate on $1 million for a future 3-month period. The interest rate for the 3-month period starts on the 3rd Wednesday of the delivery month. The contracts have delivery months of March, June, September, and December for up to 10 years into the future. This means that in 2019, an investor can use Eurodollar futures to lock in an interest rate for 3-month periods that are as far into the future as 2028. Contracts with shorter maturities are traded during months other than March, June, September, and December. To understand how Eurodollar futures contracts work, consider a June 2019 contract where the quoted settlement price on January 8, 2019 is $94.79. The contract ends on the 3rd Wednesday of the delivery month. In the case of this contract, the 3rd Wednesday of the delivery month is June 19, where R is the actual 3-month Eurodollar interest rate on that day, expressed with quarterly compounding and an actual 360-day count convention. Thus, if the 3-month Eurodollar interest rate on June 19, 2019 turned out to be 4%, the final settlement price would be 100 minus 4 equals 96. There's a final settlement reflecting the settlement price, and all contracts are declared closed. The contract is designed so that a 1 basis point move in the futures quote corresponds to a gain or loss of $25 per contract. When a Eurodollar future quote increases by 1 basis point, the trader who is long one contract gains $25. So their long price, and a trader who is short one contract loses $25. Similarly, when the quote decreases by 1 basis point, a trader who is long one contract loses $25, and a trader who is short one contract gains $25. Suppose, for example, that the settlement price changes from $94.70 to $94.90. It's 20 basis points between January 8th and January 9th. That's one day. That'd be a radical move, but let's just go with it. Traders with long positions lose $275 per contract. 25 basis point rule is consistent with the point made earlier in that the contract locks in an interest rate on $1 million for 3 months. When the annual interest rate shifts by 1 basis point, the interest accrued on $1 million over a span of 3 months also changes by $1 million times 0.0001 times 25 equals $25. Since the futures quote is 100 minus the futures interest rate, an investor who is long gains when interest rates fall, and one who is short gains when interest rates rise. Keep that in mind. Who's long, who's short? On January 8, 2019, an investor wants to lock in the interest rate that will be earned on $5 million for 3 months starting on June 19th. The investor buys 5 June 19 Eurodollar future contracts at $94.79, or approximately 5.21%. on June 19th, 2019. Remember, January 8th, June 19th, June 19th. The 3-month SOFR interest rate is 4%, so that the final settlement price to be 96. Remember, 100 minus 4. Investor gains 5 times 25 times 9,600 minus 9,470. Why? That was the purchase price. Remember, 9,600? That's what they sold it for. That's what they bought it for. Equals 15,125 on the long futures position. The interest earned on the 5 million for 3 months at 4 is 5 million times 25 times 0.04 equals 50 grand. The profit on the future contract pumps this up to 65,125. This is the interest that could have been made had the interest rate been 5.21%. 5 times 25 times 0.0521 equals 65,125. This illustration shows that future trades has the effect of locking in an interest rate equal to 100 minus 94.79 or 5.21%. The exchange defines this contract price as 10,000 times 100 minus 0.25 times 100 minus Q, where Q is the quote. Thus, the settlement price of $94.70 for the June 2019 contract corresponds to a contract price of 10,000 times 100 minus 0.25 times 100 minus 94.79 equals 986,975. The final contract price is 10,000 times 100 minus 0.25 times 100 minus 96 equals 990. And the difference between the initial and final contract price of 3,025 per contract, so that an investor with a long position in 5 contracts gains 5 times 3,025 equals 15,125. Brad Williams, Frugal Finance. Thanks for watching.